On behalf of the National Glass Association, I'm Sarah Neiswanger, Associate Director of Industry Engagement, and I'm joined today by my colleague Lori Cowan, Editor of Window and Door Magazine. And we thank you for joining us for our final Thirsty Thursday webinar of 2024, welcoming back Chris Beard of John Burns Research and Consulting. Before we begin, let's see what's also coming up around the NGA. We've talked about the NGA Glass Conference before, taking place in early February in Carlsbad, California, which is just north of San Diego. Registration is open and early bird rates actually end January 7th. The hotel reservation deadline is right on its heels, with group rates only guaranteed through January 10th. So make it easy on yourself now and go ahead and sign up before the holidays so you have these deadlines off your list. Among other activities, we're also celebrating the 10th annual fun run at this event, which is also always a highlight of the conference. So use the QR code on screen or visit glass.org and find the NGA Glass Conference in the events drop-down menu. The BEC conference, now in its 27th year, will return to Las Vegas in early March. This is one of the top events of the entire glass and glazing industry, and registration opened just earlier this week. We're focusing on people, profits, and performance in glazing. More details will continue to be added as our speakers are confirmed. So again, use the QR code on screen or visit glass.org and find the BEC conference in the events drop-down menu. I'm now pleased to introduce my colleague, Lori Cowan, editor of Window and Door Magazine. Lori has 16 years experience in editing trade publications for the construction industry and has been with the NGA for the past 5 years. So Lori, tell us a bit more about what to expect with today's session.
Thank you, Sarah, and thank you all for joining us for our last Thirsty Thursday of 2024. I'm happy to once again introduce Chris Beard, Vice President, Building Products Research at John Burns Research and Consulting. Chris is well-versed in the dynamic environment surrounding building products, helping clients and partners understand trends and inflection points within the broader building products and housing industry. In addition to the Window and Door Market Survey, which you will hear the results of today, Chris leads John Burns' monthly dealer survey, as well as a quarterly survey of structural component manufacturers, plus he monitors public building products companies' earnings. It's hard to believe that Chris and I have already been working together for more than a year now to deliver their quarterly Window and Door Market Survey, which continues to grow and offer more insights each iteration. Chris, take it away.
Great, thank you, Laura, and it's a pleasure to be back with everybody. Good afternoon. So we're going to follow a similar outlook that we did in previous webinars. We're going to start with a post-election backdrop for housing, then get into some new construction insights, what we're hearing in the repair and remodeling market, and then, as discussed, our insights from the latest Window and Door Market Survey, highlighting the third quarter results that we heard from manufacturers and dealers. And then we'll wrap up with some takeaways, and we should have a little bit of time for Q&A at the end. So let's dig in. So job growth has been very solid this year. We had a very strong report last week that came out. And so that's giving some input as to what the Fed might do with regard to further rate cuts when they meet at their next meeting in December. But we have seen solid job growth, but really less so than last year. In the prior 12 months, there were 2.9 million jobs gained in the U.S. And over the last 12 months, there's only 2.2 million. So a slight decline. Still solid growth, and we saw a very soft number in October, but that was primarily related to hurricane interruptions and some hiring and slowing due to the hurricanes. This is a quote that came out last week, and this is from Raphael Bostic, President and CEO of the Federal Reserve Bank of Atlanta. And I've highlighted here, said if labor market conditions are worse than the committee colleagues thought a few months ago, that probably bolsters the case for continuing to remove policy restrictiveness and perhaps argues that we should do so more aggressively. So this president of the Atlanta Fed is signifying that they may actually accelerate rate cuts if the job market continues to be soft. We're hearing from recruiting firms on their earnings calls that they're saying their clients are being cautious on hiring, but are optimistic that these rate cuts will continue to spur growth and hiring in 2025. You can see quote from ADP, clients continue to hire employees at a modest pace. Demand remains pretty consistent. Robert Half is saying client budgets remain constrained. Aided by continuing progress on inflation, beginning of a global rate cutting cycle. Manpower saying there hasn't been a significant tone change in the conversations they've been having. Most are optimistic, yet cautious about market conditions. And that's kind of how we're viewing 2025 right now. We're cautiously optimistic that we're going to see a rebound in housing through many of the examples that I will talk about today. The current inflation rate is back close to where the Fed wants it at around 2%. We had the CPI print yesterday of 2.7%, but the Fed's preferred measure is PCE, personal consumption expenditures, and that's around 2.3%. So it's right around the target of where the Fed would like to be. And that, of course, gives Jerome Powell the thumbs up to continue with rate cuts. After the labor market report last week, and then after the inflation report yesterday, most economists are still relatively optimistic that we'll see another 25 basis point cut in short-term rates when the Fed meets later this month. We do expect short-term rates to decline due to the Fed rate cutting cycle. And that really has implications on a number of different things, not necessarily mortgages, because mortgages are tied to the 10-year treasury. But you can see this green bar here, the HELOC rates. HELOCs are more closely tied to short-term interest rates. So as the Fed begins their rate cutting or continues their rate cutting cycle, we do expect home equity lines of credit to increase. And I've got a few slides on that later on too. We talked a little bit about this too, but unprecedented foreign immigration is contributing to employment growth and household formations. In 2024, we estimate about 3.6 million immigrants coming into this country. We're anticipating a little bit less for 2024, and then with the new administration, we're expecting further declines. But this has led to household growth. And we think that this immigration wave caused about 700,000 more households than normal over the last 3 years. And the math for that is, in a normal year, we anticipate there's about 1.2 million immigrants per year entering the US. And the math that we do on this is about 4.4 immigrants equals one household, and that comes up to about 270,000 households in a normal year. From 2022 to 2024, we're anticipating 2.7 million per year, and that's around 500,000 additional households formed due to that wave of immigration. So this above normal household form over the past 3 years, we think leads to 700,000 new households that have been formed since 2022 and through the end of this year. This really pulled the bottom of the rental market forward 8 months. We've talked a little bit earlier this year and last year about the declines in multifamily that we were expecting. And we predicted that to be a multi-year decline just due to the number of apartments and multifamily units that were coming online. But if we do the math here and we think back to the previous slide, 700,000 net new households, we think that equates to about 600,000 renter households. So about 150% of the typical annual multifamily construction volume, and around 100,000 owner households, which represents about 10% of the typical single-family new construction, if we think of roughly 1 million single-family starts every year. For the first-time home buyers represent less than 25% of all home sales for the first time ever. There's been a lot of talk about production builders and entry-level homes taking share, and that is true, but we've started to see a significant decline in first-time home buyers, again, due to affordability, rising interest rates, homes becoming more expensive, and those first-time home buyers being priced out of the market. And when we look at the median age for home buyers, the blue line in the bottom is the first-time home buyers. And we're seeing since 2019 that the median age for all her first-time home buyers has gone up by 5 years. The median age right now is 38 years old. Repeat buyers, so those buyers that have previously owned a home and buying another one, has gone up by 6 years. And if we consider all buyers, that represents a 9-year increase. So we can really see the strain that affordability, higher interest rates, building material costs, labor costs, the strain that's putting on all buyers by extending that purchase cycle of a new home. And that's best represented by home buying activity being at a 30-year low. This year, we anticipate about 4 million homes, existing homes transacting. That's due to the lock-in effect, people not putting their homes up for sale, but also those high interest rates that are continuing to keep people out of the market. Nevertheless, we are seeing an uptick in resale inventory. There are more homes for sale now than any time in the last 4 years, as you can see on that chart, but still well below the historical average of about 2.25 million homes. In August, resale inventory rose about 22% year over year to 1.3 million in August, but that is significantly lower than the historical average. So we're going to be watching this closely as mortgage interest rates do come down, and they've come down for 3 weeks in a row right now. We do anticipate resale inventory to continue to creep up. But as you can see, there's still a long way to go between where we're at right now and historical averages. So let's talk a little bit about the election, because the election is going to impact housing, and a lot of it is TBD, but these are some of the things that we're looking at. So obviously, Trump-Vance won the presidency. And if we look at the Congress, the House of Representatives, the final race was finally called last week, and the Republicans have a 220 to 215 seat majority in the House of Representatives, a 53-47 majority in the U.S. Senate. And on the Supreme Court, this is obviously very less political, but by and large, it's equating to a 6-3 conservative majority. So the policies that Trump has been talking about, the incoming policy decisions, he's going to have relatively free rein to implement them. And there's been a lot of talk on what some of these policies are. A lot of it's kind of TBD. We'll see come January 20th what the policies and executives order do mean. But really, the Republicans control all 3 branches of the federal government right now. In the courts, the appeals courts are about they're equally weighted, and in the district courts, Democrats have a majority of 370 to 269. So as we expect legal proceedings to work their way through from executive orders, new legislation that may be passed, that's also something to keep in mind. That's something people don't think about a lot. The new administration has proposed tariff policies that could directly impact housing, and we're waiting to see what that is. There's been a lot of talk around the import tariffs from Canada, China, overseas. It should be noted that the Biden administration did not dial back really any of these tariffs that were implemented in the first Trump administration. And you can see the impacts. We've talked a lot about building materials costs are up 40% over 2019 levels. That's not due to tariffs necessarily. It's due to supply chain issues, rising material and labor costs, rising transportation costs. So as we think about these tariff policies that could take effect, that's something that we need to be thinking about, because overall building materials are 40% higher than they were in 2019. Another issue that's talked about is tighter immigration policy, especially around undocumented labor. And you can see, but as far as the total workforce, about 4% of the total U.S. workforce consists of undocumented aliens. But within the construction industry, you can see 19% of carpenters, 23% construction labor, 24% carpet and floor, 25% of masons, painters, roofers, drywall, etc. You can see there is a significant portion of that industry that is met by undocumented aliens. And I read something this morning that says there's about 800,000 people in Texas that are in the construction trades. About 500 of those are immigrants, and 300,000 of those are undocumented aliens. So this could have a very dramatic effect. Again, TBD, there's been a lot of talk. Nothing has been set in stone yet. We'll see what the policies end up being, but this is something that we're keeping an eye out, because we think that it could have an impact on construction next year. To wrap it up, the economy is holding up stronger than many expected a few months ago. And like I said, we're cautiously optimistic for 2025, but there are some risks. The stock market hit an all-time high in the wake of the election. Roughly 2/3 of households have at least some money tied into the stock market. So the market has reacted very favorably to a pretty decisive outcome to the election. I think the worst case scenario probably would have been that there was no decisive outcome. This would have been wrapped up in the courts. But the fact that the election turned out the way it did really gave the stock market some tailwinds. The Federal Reserve did cut interest rates by another 25 basis points in November. We expect another 25 basis point cut in December. This immediately translates to easier access to capital for short-term loans, really things that are dependent on these short-term interest rates, such as corporate debt, commercial real estate loans, home equity lines of credit, and adjustable rate mortgages. Adjustable rate mortgages still are not a significant portion of the overall mortgage industry, less than 10%, but this does have an impact. And then long-term treasury yields rose after the election as the market started to react to the potential impacts of Trump's policy decisions. Again, nothing's set in stone. We're still kind of waiting and seeing what's going to happen. And that seems to be what we're hearing in the industry right now overall, is wait and see. We do expect modest growth for housing in 2025 as everything kind of settles, as dust settles, and we figure out what the policy decisions are going to be. And we're seeing consumer sentiment increase, which I believe I talked about in the last webinar, that was the biggest barrier to growth. So we're seeing some positive indications right now for 2025, but we're just going to have to wait and see until we get further into the year. So looking at new construction, this is from our monthly builders survey. We survey about 20% of all new home sales and starts each month. And we can see new home sales in November were up 4% year over year and about 14% above the average November from 2012 to 2019, which we call more normal years. So these are new home sales net of cancellations. But new home starts have been declining. They're still up 8% above the November average from 2012 to 2019. But you can see there is a drop off between what we're seeing in September, October. There was a drop off. And if we put it all together and look at a longer time series, we could see there was a slight increase in new home starts in October, but then a 9% decline from a robust 52% growth 1 year ago. What we're hearing is builders are tapping the brakes on starting just because of just to align with cooler demand. So people kind of waiting on the sidelines and seeing what interest rates are going to be doing. As I mentioned, mortgage rates had been ticking up after the election. Few builders are indicating that they're ramping up starts or really stockpiling components in advance of expected policy announcements. Most are really in that kind of wait and see approach. We'll see what the next year brings once we move into the new administration and see what the policies are. They're kind of waiting and seeing before they're starting new homes. Another reason is we're seeing unfinished or unsold finished inventory. So these are homes that are completed but not yet sold. We're seeing a pretty significant jump, and you can see the seasonal historical averages around 2 homes per community. That's now roughly 1 full home per community higher. And again, this unsold inventory these are homes that are completed but not sold yet, as homeowners are kind of waiting on the sidelines, seeing what interest rates are going to be. Many builders are intentionally building more inventory than usual. We're hearing them, number one, to facilitate quick move-ins. So they've got a home that's ready to go. They have a willing home buyer. They can offer the incentives, the lower mortgage rate, buy down that mortgage rate, and the home buyer can get in there pretty quickly. And then they're also wanting to capitalize on that weak resale inventory and builders' willingness to compensate buyers' agents, again, with the NAR settlement and how real estate agents are compensated. 40% of builders average 1 to 2 finished homes per community, which is kind of in that normal range. But entry-level builders, again, targeting that entry-level audience, production builders, they generally have higher inventory to get those quick move-in buyers in there. New homes are becoming simpler in design. We've talked about this in the past, really trying to solve for affordability and really trying to keep the home price as inexpensive as possible. So this is an example of Rancho Mission Viejo in California, very simplistic home design, and we're seeing fewer window units being installed in these homes as the designs have become simpler. We did the math, and we looked at the number of units installed per home across the years. We have data going back through to 2000, and we have a forecast back up into 2027. Once we get into the new year, we'll have our forecast through 2028. But homes in 2025, we think averaged about 21 window units per home. That did come down a little bit up to 2019, where that fell by about 2 units, 19 units per home. Now, during COVID, as interest rates became really low, home sizes started to creep back up during the 2020 to 2022 years, and we did see an increase in the number of units, but we're kind of seeing that whittle away. And we think in 2027 there's going to be 18 units per home, which is a significant decline. 3 window units per home, if you think about 1 million single family starts per year, that can be pretty significant for the industry. We think about the types of homes. We've been seeing the publicly traded companies, builders really gaining market share. And so now, including subsidiaries, these publicly traded companies now comprise 55% of all new home sales. You see that continues to march steadily higher. On an individual basis, D.R. Horton and Lennar sell almost 25% of all new homes in the U.S. We expect that to continue. We expect these big builders to continue to take market share, especially in this higher for longer rate environment, because these publicly traded home builders are better equipped to do mortgage rate buy downs and get homeowners into the homes at a lower mortgage rate versus the prevailing market rates. So we do expect these public builders to continue to take share as they've done over the past several years. Last month, we surveyed home builders and we said, okay, let's think about all of the supply chain issues that we had. We're thinking rates are going to come down. There's going to be stronger demand for single family new housing. How much do you think starts can grow before we start to see supply chain disruptions again? And so they think that nationally, on a national basis, you can see we have regional breakdowns here. On a national basis, they believe starts can grow by 15% next year before we start to see some supply chain issues creep back up. That really implies around 1.1 million single family starts versus 2024 levels. We asked a similar question of the building materials dealers because they're the ones that are supplying these builders and they're the ones that are supplying the product for these homes. And they think that the housing starts can only grow by about 10% before we start to see supply chain disruptions. And then we asked, well, what categories do you think are going to be most susceptible? And wood panels, 24% of them said, yeah, I think we might have some tightness in wood panels. 19% said in dimensional lumber. But in third place, and I think this is a little bit of recency bias from the last supply chain issues that we had, 18% of dealers said that they do expect to see some issues in windows and doors in getting adequate supply into the market if starts do grow by more than 10%. So now we'll move into some repair and remodeling insights. I've shown this slide before, but I'm going to spend a little bit more time on it again. As we all know, there was a boom during COVID. People were not spending money on travel, hospitality, leisure, etc. So they were investing more in their homes, especially as that stimulus money came in. This black line at the bottom at $0, that is what we consider normal spending. So we took normal spending on home improvement for the years prior to COVID, the several quarters before COVID, and said, okay, that's the baseline normal, and there's a little bit of inflection that did go up by a few percentage points every year. So we counted that as normal. Then we calculated the amount of home improvement spending done during COVID above that normal trend line. We have no reason to believe that that trend line isn't going to continue, that things revert back to the mean, that we're going to revert back to kind of normal spending on home improvement. And since the second quarter of 2024, we've been below that normal trend line, and we're calling that pent-up demand. So we think this is below normal this year, again, due to affordability, due to interest rates, due to the kind of wait and see approach. And we think that all of this pull forward demand that we saw has been completely exhausted. So once we start to see some improvement in the capital markets, once consumers do become more confident in their overall household finances, the direction of the economy, we do expect that to get back up to those normal spending on home improvement. But we are in a state of what we'll call deferral or pent-up demand. Home equity is still massive, around $400,000 per owner household. We think that's going to be massive dry powder to fuel large remodeling projects. In this current downturn in repair and remodeling, larger projects have been the most susceptible to deferrals and cancellations. And we see, if we do we did an analysis of the percentage, the green on the chart on the right, the green is funded with home equity balance, and the blue sections represent cash out refis. And you can see those projects that are over 70,000, 33% of them are funded with home equity lines of credit. So as we see short-term interest rates come down and home equity lines of credit interest rates come down, this is going to provide massive dry powder. And if we look at this is our projections for the blue line is the Fed funds effective rate. So the interest rates that the Fed controls, short-term interest rates, and then our projections for home equity lines of credit interest rates. And we can see following a rate cutting cycle, we typically do see an increase in the balance of home equity lines of credit. You can see some examples. 2019 is a little bit different during COVID because the debt markets were really frozen. But in August 2008 was the last rate cutting cycle, increase in HELOC balances of 12.3%. In 2020, up 20%. May 1995 was probably the last soft landing year, and that was up 4.2%, and then in the late 80s, up 22%. So we typically do see an increase in balances for HELOCs after the rate cut cycle. As interest rates do come down, homeowners say, okay, I'm going to feel more comfortable to get a short-term loan for some home improvement projects. We also did analysis of what type of projects are susceptible to this. And the top 10 are things like kitchen addition, bathroom addition, pools, bedroom additions, other project, kitchen remodeling, siding. Those are the percentages that are typically funded by HELOC home equity lines of credit. So 36% of kitchen additions are funded with HELOCs. Doors and windows is kind of that bottom 10, but still at 10%. So HELOCs are used to fund whole home window replacements, window and door replacements. So we think this is going to be a tailwind once HELOC rates come down and homeowners start tapping into that massive equity that they've built up. Another thing is rising household wealth. That really correlates very nicely to spending on home improvement. The blue line is that homeowners spend on remodeling projects $30,000 and above, and the green line is household net worth. And we can see a strong correlation when household net worth creeps up. We see an increase in homeowner spending on large remodeling projects, and we expect that to continue. Now, this is all household wealth. So this includes equity in the home. It includes 401k balances, stock market holdings that people may have, as well as savings. So we've seen an increase in household wealth over the past year, and that's ticking upward. And we're starting to see a very slight increase in homeowner spend. Still negative year over year, but we do expect that blue line of homeowner spend on these large remodeling projects to increase as household wealth is maintained. Another thing is remodeling spending intensifies as households age into their 40s. No surprise, you go from a move-up home or you go from an entry-level home into a move-up home, and we're starting to see stronger spending in a couple different ways. Number one is households get into their 40s, kids become older, they have more kids. And then also when they're in their 60s, there's downsizing too, preparing for aging in place. Our demographics team anticipates really strong growth in households entering that 35 to 44 age range in the next 3 years, which we also think is going to be a tailwind to remodeling. Number one, because of the age of housing stock and the undersupply of homes that we have in our country. Despite a weak building products demand environment, we still see skilled labor availability as the barrier to growth. And the chart on the left is from our recent U.S. Remodeling Index. We survey roughly 500 professional remodelers, and the number one barrier that they cite as growth is consumer uncertainty. No surprise there. But number two is skilled labor availability. That continues to be a barrier to growth. So think skilled labor like carpenters, electricians, plumbers. The shortage of that, we have still not seen a positive growth in skilled labor. And we can see that by the chart on the left, unemployed persons per job opening in construction, it's still very, very low compared to historical standards. Now, we do hear others talk about, well, we expect there's going to be a significant remodeling boom of maybe potentially even double-digit growth next year as the Fed continues through this rate cutting cycle. And we did see in the 80s about 20% growth in remodeling coming out of the high inflationary period, high interest rate period as rates started to get cut, significant growth in remodeling. But what's different now is in the 1980s, unemployment was around 10%, and right now it's around 4%. So we just think that this is that labor inflation is going to continue. We've seen labor inflation over the past several years. I'll get to what that means for the fenestration industry in a second. But labor continues to be that barrier to growth, and we think that that's the shortage of labor, especially if some of these immigration policies are implemented. We think that there may be labor inflation, which could further strain the growth in repair and remodeling. Another thing is we expect disaster repair spending to continue to march upward. This chart is from homeowner spending on disaster repairs in real US dollars, and you can see over the past several years, it's marched upward. We expect record spending in disaster repair in 2025 just due to the amount and the magnitude of the natural disasters that we've had. So that's competing with some R&R projects that may have been done for remodeling, where the repair aspect of it is competing. And again, coupled with skilled labor availability, that could impede growth. So that's something that we're watching pretty closely. So now we'll move into the insights from the latest window and door market survey. A little bit of background as we've done in the past. This is an exclusive partnership between John Burns, our firm, and Window and Door Magazine. It's a quarterly survey of residential manufacturers, glass shops, glaziers, and installers. We ask things about volumes, revenue, lead times, backlog, supply chain, and then guidance. And then it's all combined together with qualitative data and commentary that we get from the respondents. I'll have a sign-up link at the end if you're not already participating. But what I've always stressed, and I'm going to continue to stress, is we guarantee complete anonymity and confidentiality in that. When you do respond to this, you can be very assured that the results will never be tied back to your company, nor to you specifically. So you can have confidence to respond. And that's why we get the responses that we do, is because we do guarantee that confidentiality and anonymity. So the responses are completely confidential. We don't share where they're from. I don't even see where they're coming from. So we do feel confident in the data that we do receive. So 4 key takeaways: softness in 2024, but very bullish on 2025. We're seeing a continuation of missed shipments and revenue results, relatively benign material and labor inflation, but staffing plans next year to support growth that's expected, and very optimistic 2025 expectations. So in the third quarter, only 25% of window and door companies reported volumes growing, and average volumes grew by 1.4% year over year. We ask this question every quarter of how much do you think volumes are going to grow next quarter, and how much do they grow this quarter? Throughout all of 2024, companies have missed the growth expectations. So in the second quarter, I believe companies said they expected volumes to grow by 2.6%. When the results came back, they only grew by 1.4%. And you can see only 25% of respondents said that their volumes did grow. 50% reported flat, and then 25% said declining volumes in the third quarter. From a revenue standpoint, 50% said that revenue did increase in the third quarter, but it was pretty flat. Revenue increased by only 0.3%, but this was the first quarter in 2024 that companies did report on aggregate revenue growth. Now you compare this 0.3% with the 1.4% volume increases. So that implies that there was trade downs, mix shifts. We're seeing less costly materials installed, continued trade downs in the products installed, because the revenue growth was significantly less than the volume growth. And we expect that trend to probably continue into next year, again, due to affordability and the high cost of building materials. They're reporting slight year-over-year inflation and material input costs. So 3% material input costs year over year, that has been moving up a little bit as we move through the year. It was 1% in the first quarter, now 3% in the third quarter. And labor has been relatively flat. Labor inflation, direct labor costs, again at 5% year over year in the third quarter. It was down 4% in the second quarter, but 5% in the first quarter. But that is down significantly from what we saw last year. So again, as the labor market has become a little bit tighter, it's been easier to find and retain talent. They haven't had to have as strong pay increases to retain talent or to get talent in the door. But still, 5% is still very healthy labor inflation. When we asked about project backlogs, 38% of the respondents said that their backlogs did decrease. Another 38% said they stayed the same, and only 25% said that they actually increased their backlogs in the third quarter. That's been relatively consistent. Backlogs have been relatively flat, and we expect that to continue moving into next year. But the expectations for next year are for growing sales and volume, which we'll get to in a second. So we're going to be watching this pretty closely to see if these backlogs do in fact materialize as we end this year and move into next year. When we say what products are you experiencing extended material lead times, or what things are kind of on delay that you're having trouble getting, 75% said none. Everything's good. We get the supplies, the raw materials that we need to manufacture the product and install the products that we make. 25% did say they're starting to see a little bit of issues with float glass. I'm going to say that's a little bit of an anomaly right now. I believe last quarter 90% said they're not seeing any issues with the raw materials that go into the product. So that's good news. That's what's allowing backlogs to kind of be whittled down and lead times to be in kind of that normal basis. 25% of companies expect to ship more units this quarter, the one we're in fourth quarter right now, versus 2020 versus the third quarter. So we're at the end of the year, we're in seasonality. Really no surprise that companies are expecting quarter over quarter, 38% saying lower volumes, another 38% said about the same. But if we aggregate everything together, the expected shipments change is expected to decline by 0.5%. Again, nothing to really get alarmed about. We're at the end of the year. People are still in that wait and see approach. We're achieving normal seasonality with the holidays, colder weather, with replacement. So no real surprise here, but you could see this difference that I mentioned, that I talked about before. In the first quarter, they said shipments were going to be up 6.4% in the second quarter. In the second quarter, they said shipments were going to be up 3.5% in the third quarter. And then we see the third quarter results and shipments are only up 1.4%. So this theme of kind of missed expectations has permeated throughout all of 2024. It's good to be optimistic. And it's very healthy to be optimistic in this industry, of course, but we have seen repeatedly these expectations have not quite been met. As we entered 2024, we expected the interest rate cutting to begin sooner. We thought that the Fed would start probably mid-year. Inflation came in at the beginning hotter than expected, and the labor market did soften a little bit. And so we think that that's probably the reason that we're just kind of like kicking that can of expected growth down the road. And then now we're moving into 2025. Thinking about the full year revenue, 83% of companies expect full year revenue to be the same or slightly higher than 2023. Average revenue is expected to increase by 2.1%. So after a very soft 2023, manufacturers came into the year feeling more optimistic about 2024. And again, that hasn't really materialized as we move through this year. So we'll see how 2025 shakes out. Thinking about 2025, 63% of companies expect to raise prices next year. The average expected price increase is expected to rise by 4%. So we're kind of back in that normal cadence of 3 to 5% price increases, annual price increases. So we're going to be watching the inflation aspect for materials as well as labor pretty closely. That's why we asked that question. But right now, 63% said they're going to raise prices by an average of 4%. So if you're a distributor, or if you are a builder looking at this, that's something to take into account. And the reason is because, again, as we've seen, manufacturers continue to experience material and labor inflation. We do expect that to continue, hence the need to get back in that normal cadence of annual price increases. Most of the companies, 88%, say they expect shipments to increase for full year 2025. They're expecting shipments to increase by 10% year over year, so versus 2024 levels. This is very significant. I don't know the last time we saw 10% industry growth, even during COVID. So again, back to that point about this industry is very optimistic looking into next year. They're saying shipments up 10%. From a revenue standpoint, 100% of the respondents said that they're expecting revenue to grow next year, and they're saying by 10.5%. So if we go back to that previous slide of shipments and volume up 10%, revenue up 10.5%, that continuation of the trend that we're seeing of trade downs and mixed quality, we expect that to continue. So because of the revenue is expected to only be slightly higher than shipment expectations, we do expect to continue to see some mixed headwinds. Again, affordability is not really being solved for. Products are expensive, and so we expect that continuation of trade down in product quality. No window and door companies plan to reduce their production workforce next year. This is in the third quarter. We asked them, are you planning on adding or reducing production workforce? And we have seen some in the industry, so take this with a little bit of a grain of salt, but this is looking into next year. 67% say there's no changes planned. 33% said they're planning to add. So again, these are 2025 expectations. So thinking about where we end up in 2024, these are 2025 expectations. 63% said they're not planning on making any changes to sales and marketing resources, and another 38% said they're planning on adding to sales and marketing. In a continuation of what we've been hearing, the industry is having to relearn how to sell and be out front of business, selling to homeowners, selling to builders and contractors. Marketing and building that brand allegiance that was had pre-COVID. We expect that to continue, and that's why 38% said that they're planning on adding to sales and marketing resources, as orders are just no longer flooding in, but it needs to be worked on. There needs to be outbound marketing and active sales process. We ask also each quarter what the main focus area is for the next 12 months. And this is specifically for the manufacturers that we asked this. And 22% said their main focus area, so they can only select one, their main focus area is around code changes or energy efficiency. This was further down the list previously. So for 2 quarters in a row, energy efficiency and code changes has been the main focus area, ahead of the previous number 1, which was production automation, and then also design enhancements, footprint expansion. So it's really interesting to see. Number 1, it's going to be interesting to see what happens with the Inflation Reduction Act under the new administration and the new Congress. But nevertheless, energy codes are kind of a patchwork of local building codes. And we're starting to see more municipalities increase their energy efficiency standards in their building codes. And that seems to be getting through to the manufacturers that, okay, we need to solve for this. We need to create products that really help meet these energy code standards. Homeowners are starting to ask for this more and more. So it's interesting that this is taken over as the number one focus area for companies, for manufacturers over the next 12 months. So we'll get into some takeaways, kind of wrapping things up. And I think we do have some time for some Q&A. But the main takeaways are the labor market is slowing as the Fed has started cutting short-term interest rates. The market is easing and hiring is slowing, but the economy is stronger than anticipated. It appears that, it's very probable that we are going to achieve that soft landing, but risks do remain for 2025, again, due to policy implications that we may have, and then how the labor market fares. New construction is declining year over year as builders are really in this wait and see mindset. Starts are down against a really strong comp from last year, but really in line with seasonal norms 2012 to 2019. So nothing to really be alarmed about. And homes are continuing to get smaller as big production builders dominate the market, and they're downsizing that homes just to keep that price down lower. The R&R market, we're continuing to say it's pent-up demand. We're in a state of deferral. As short-term interest rates do fall, we expect home equity to be tapped to fund these large remodeling projects, which includes whole home window replacements, as we talked about. Labor shortages are continue to be that barrier for growth, especially as disaster repair spending next year competes with other remodeling projects. And then window and door companies expect strong volume growth in 2025. They note shrinking backlogs, but are very optimistic about the demand outlook heading into next year. But again, we're going to take that with a little bit of a grain of salt because the expectations for 2024 were not met. But the industry, by and large, is expecting a turnaround next year. So we think the industry remains optimistic about demand from new construction R&R. There are some near-term headwinds. We'll get through, we'll get into the spring and see where things shake out from an interest rate standpoint, from a policy standpoint, from an inflation standpoint. But overall, the industry is optimistic, and we think that the industry is going to return to growth next year. So with that, I'll go to the last slide. This is a QR code if you'd like to scan that to participate in our quarterly survey. If your firm does not already do that, you can scan this and fill out a form, and then I will reach out to you with that. And we'll leave it on here, and I think we can take some questions.
Thank you so much, Chris. That was a wonderful presentation with so much information. I think we'll take a little bit to digest all of it. We do have a couple questions to discuss. The first question is, do you think window sizes have gone up and it will... Sorry, let me start that again. Do you think window sizes have gone up and it will set off decline in number of windows in a house as overall square footage will be similar?
That's an interesting point. And overall, yes, but there's definitely, we've been seeing a bifurcation in the market. So we have a quarterly survey that we do with custom home architects. So these are the move up and custom, semi-custom homes. And architects are reporting more and bigger units in homes. So this for the larger homes, bigger units, larger openings continues to be a trend. They expect that trend to continue, as do I. On the flip side, entry-level production homes, we are seeing fewer units, as I discussed, but also smaller units too. So as square footage comes down, we're also seeing the size of the individual units, the individual openings also coming down too. So it really depends. We talked about the growth that we're seeing with the production builders, the national production builders. They certainly are going to continue to take share when you think about overall starts. But if you're skewed more to the custom side, custom home builder or semi-custom home builder, there's a good chance you're going to see more units in larger units. So it really depends on the end market, but that we're continuing to see that bifurcation between production and custom. But again, as an aggregate, we do think the number of units is going to come down simply because there are more production homes constructed than custom homes in the U.S.
You mentioned that with the window and door quarterly survey that quite a few manufacturers mentioned that they are seeing the revenue growth less than the volume growth. Are other building product areas seeing a similar trend?
We're seeing that trend. So we do a monthly survey of building materials dealers. So the best way to think about these guys is pro dealers. They're independent pro dealers. We capture a good chunk of the market each month, and we're seeing very similar trends. Expectations for next year is slight volume growth, and expectations for across all categories. So think things like, you know, wallboard, drywall, flooring, siding, roofing, and then and then slight revenue growth too. So relatively flat volumes and revenue next year, up, you know, single digit percentage, mid-single digit percentages as an aggregate. And certainly that the trade down aspect has been part of that too. And again, it's just mix shift down due to affordability. We gave a webinar the other day, our New Home Trends Institute, and we talked a little bit about kind of that trend. So on the one hand, we're seeing trade downs. We're seeing manufacturers come out with, we actually called it the entry level. So manufacturers coming down with even a notch below of their entry level products, again, to satisfy that demand for affordability. But on the flip side, we're also seeing some trade ups due to weather resiliency. So areas that are really prone to storm damage, as insurance premiums are increasing in many parts of the country, not just in Florida, Texas, and California. We're seeing products that are being engineered to be more weather resilient, hail resistance, impact resistant glass. And so I hate to keep using that word, but a little bit of bifurcation too. So in areas that are impacted by weather, homeowners are saying, you know, I'm going to trade up to something that's going to be a little bit more resilient, especially as we take into account that lock-in effect of low mortgage rates and people staying in their homes longer because they have a low mortgage rate. They're going to put in some higher grade products that are going to last a little bit longer and be a little bit more resilient against Mother Nature.
Do we see any end to rising home costs? When do you expect that to level off?
That's a good question. And we are expecting a normalization of new home price appreciation next year. Resale price appreciation continues to outpace new home price appreciation a little bit, again, just due to limited inventory. So I think interest rates need to come down, mortgage interest rates, and then especially for the resale market, mortgage interest rates for homeowners to feel comfortable moving again, putting their home on the market and finding something different. Until we start to see those rates come down a little bit more, we probably won't see that leveling off. We've been in an area right now of kind of normal inflation, if you will. That's throughout 2023 and now 2024. That's been the case. So will we ever get down to 2019 levels? No, but that would also imply deflation, which is something else nobody wants, right? So if you're a manufacturer, you don't want to have to lower your list prices. But the rate of change, the rate of increasing building material costs being, you know, up double digits off of prior year, you know, we want to move out of that area and kind of that normal late inflationary market. And so that's why we're watching really closely some of the policy decisions that are going to be made, what that's really going to do. Short-term interest rates are going to continue to fall. We seem to be in that normal range of price increases across all building products categories. We're back to that annual price increase of, like I said, 3 to 5% by and large, generally speaking. So that's good news. But the overall cost to income, you know, income to ratio for a homeowner to actually be able to afford, that's been significantly higher, and we need interest rates to come down for that to kind of normalize into that range where it's a normal, healthy range for a cost to income ratio for housing.
Will aging boomers selling off homes help, or do you think it won't because the homes might be too expensive?
It may help, but I will say, we don't see a significant wave of aging boomers flooding the market with flooding the resale market with existing homes. So we're seeing number one, mobility has been on a downward trend for a number of years, people staying in their homes longer. We've seen advancements in aging in place, older boomers being able to stay in their homes longer. We're not expecting a significant wave of homes to flood the market, the resale market for aging boomers. But yeah, we still have a large generation of the millennials coming into market too, in addition to the immigration we talked about, but too, the wave coming in with millennials is also very high. So we think there might be a little bit of equilibrium, and we don't expect a ton of resale supply to come on to really push down home values. We're continuing to call for resale home price appreciation next year too.
We have a question about some regionality. The market is not the same across the country. Where do you think there will be hotspots in 2025?
We've seen on the new home market, we've seen some softness this year in Florida and in Texas, especially a little bit in the Southeast. And I think at Glassbuild, I touched on this a little bit too, but the softness is really year over year, and it's kind of because those markets were late to the game. They stayed resilient longer when the rest of the country and the new home market turned a little bit softer. Those markets stayed a little bit stronger. Those are areas that we're watching. Obviously the migration patterns, moving from the Northeast to the Southeast because of better weather, lower cost of housing, ample employment. We expect those trends to continue. So those growth markets of like in the Southeast markets, those are going to be pretty healthy. California is still relatively strong too, despite the affordability challenges. But we're seeing some pockets in the Midwest too, where we think there's going to be some growth too in some of the larger Midwest cities. So we do quite a bit of work on demographics to show migration patterns where people are moving to and where people are moving from that I'm happy to share. You can reach out to me directly. My contact info is on here, and we're happy to share some of that. But yeah, kind of the Southeast, and generally speaking, is going to remain pretty strong.
Are tax incentives found to be helpful?
It depends who you ask. So this is, and I'm not being flippant by saying that, because we did see the tax incentives in the 2009, 2010 timeframe. We did see them as definitely driving replacement for energy efficiency products, specifically windows. There was a clear bump during the Obama administration when that came out. We saw a clear bump in window replacements. The incentives, the tax incentives for the IRA, the Inflation Reduction Act, were not as strong. And the payback, you can ask, you can say, is it worth it to have an Energy Star 7.0 window because the cost is so much higher than the actual tax incentive you're going to get. There was a lot of cynicism in the industry around that, like, is it going to be a driver, yes or no? I'm kind of more on it's not going to hurt, but is it going to be a significant tailwind? Probably not, but it certainly isn't going to hurt the IRA, the tax incentives from the IRA. But it is kind of changing behavior changes too, right? So like I said, in the main focus area for manufacturers over the next 12 months, that energy efficiency and code changes, that has kind of bumped up. And certainly there are some tax incentives that go along with that too, to kind of change that behavior from a consumer standpoint, not just in code changes, but also incentivizing energy efficiency products. I would say, generally the tax incentives that we have right now are probably not as impactful as initially thought, but again, certainly not a headwind either. We think that still is going to be a tailwind.
Yes, thank you again, Chris. Our next webinar is January 16th, and we'll use this time to tour the latest from within the NGA, and in particular, how to maximize your membership with our newest offerings. Thank you again for spending this hour with us. We wish you the best for the holiday season and are eager to partner with you to make 2025 another terrific year for your companies and our industry. Have a great afternoon.